Income tax 2020, Schedule C, taxes, expenses. Come in, relax with income tax 2020. Schedule C, taxes, expenses. With regard to the income tax equation and a sole proprietorship Schedule C, we're talking about line 1, the income line, remembering that we do have a separate schedule, that being the Schedule C, having an income and expense section to it. The bottom line, in essence, net income of the Schedule C, then flowing into the top line of our income tax equation, where we then apply out the above the line and below the line deductions to get down to the taxable income. We're now going to be considering taxes as a part of possible expenses, mainly on the Schedule C or related to the business that may be deductible in other areas. We've touched in on a couple of these items in the past, so we're going to review some of those items and just discuss and focus in on taxes in general. Taxes can be a little bit confusing because, of course, we are calculating the taxes here. This is going to be the federal income tax that we are calculating. Now, typically, if you're thinking about the federal income tax, then that's not generally something you can deduct on the Schedule C or in the equation for the federal income tax, because that's what we're calculating, and that would create kind of a circle reference. So federal income tax, you would think then not typically deductible. However, if you're talking about federal self-employment tax or federal payroll taxes, that being Social Security and Medicare in two different formats, then those may be something that could be deductible related to the business. The payroll taxes would then be on the Schedule C, and that would be part of the payroll process. So when you do the payroll process, as we discussed in a prior presentation related to the deductibility of payroll, then we have the calculation of the taxes, some of those being pulled out of the wages of the employees for Social Security and Medicare, for example. And those items would not be deducted as payroll taxes, but would be included as part of employee wages, which we paid on their behalf to like the government. And then we have the employer side of taxes with regards to payroll, Social Security, and Medicare that we had to match over and above what we paid the employees, which may then be deductible, as we discussed in prior presentations, as basically payroll taxes. We also have the bottom line of the Schedule C, on which we calculate the Social Security and Medicare for the employer taxes. That's what the employer has to be paying the taxes on, or in other words, that's what the sole proprietor will be paying the self-employment tax on, that being the Social Security and Medicare. It then would be deductible, or part of it, or one half of it may be deductible. Typically on the Schedule C, however, because that would create another circle reference, because we're using the Schedule C to calculate the self-employment tax. But as we've seen in a prior presentation, that might go up top in the adjustments to income. We also might have other state and local taxes that could be deductible. So if we're talking about the state income tax, typically the state income tax is going to be something that will be deductible as an itemized deduction, possibly. So when you actually calculate the tax or think about the tax that has been paid for the income tax on basically kind of like the net income of for state taxes, that's typically on the Schedule A, which would be able to be taken if someone is itemizing. We could have other state taxes and local taxes that might be then applied to the business, and those types of taxes, such as sales tax or something like that, or property taxes, those types of taxes and licenses and whatnot may be deductible on the business side of things. And then we could have some taxes that are being applied to both business and personal usage. For example, real estate taxes on the home. If the home is being used in part for business use of a home deduction, then one of the things we might have to be breaking out between, say, itemized deductions for taxes and the deduction on the Schedule C would then be the business use of the home related to the taxes that could then be calculated on the Schedule C. We'd have to allocate those things out then. So here's going to be the first page of the 1040. Remember that the Schedule C can have multiple impacts on the 1040. For example, it can flow over to line 8. We have one half of the self-employment tax being deducted here. That's going to be our above the line deduction for self-employment tax. That would be half the self-employment tax being calculated on, in essence, the bottom line, or in essence, net income of the Schedule C. Then we have the standard deduction, which is not going to be tied to basically the Schedule C, but standard deduction that everybody could have access to. Then we have the qualified business income deduction, which is not our focus here. Then we have the Schedule C. So this is the outline of the Schedule C. We have the income and then the expenses. We're looking down here on the taxes line primarily. But note that once again, from a logistical standpoint, if we get the Schedule C from somebody else and we're data inputting it into the system, then hopefully the Schedule C has everything in taxes already lined up and we can just input the tax line that would be applicable, those taxes that would then be related to the business. But also note that there could be some taxes that we're going to have to be calculating and entering somewhere. So for example, the 100,000 here, the software will typically help us to be calculating the self-employment tax, Social Security and Medicare on the employer side of things, and then be applying half of that possibly to be deductible as not something on this Schedule C, but on Schedule 1, as we saw in a prior presentation, as basically an above-the-line deduction. We also saw in a prior presentation the idea of the employee wages down here, and the fact that we might have payroll taxes that would be broken out for the employee wages, not the employee side of payroll taxes, but Social Security and Medicare that the employer had to match and pay over and above the salary that was paid to the employees. That should basically be broken out, and it not always is. It is not always broken out. In other words, when you get something, say, from QuickBooks, they might tie everything into, say, wages, including payroll taxes and wages, and it may end up with the same amount of deductions, but it might be kind of in the wrong line item. You'd like to break it out between the wages here and possibly the taxes related to the payroll taxes and break those two things out and be able to tie those things out to the payroll tax forms, including W-2s, 1099 forms, and the W-3, as we talked about in prior presentations. Note again, we might have some other taxes that are related to, say, like real estate taxes. And if we have something that's going to be applied to both sides, that means the personal and business, then we might need to break it out using like a home office type of breakout form so that we can allocate the proper allocation of the real estate tax between business and the personal. So from a logistics type of standpoint, then if you have some taxes that the employee, when you look at the tax line item on the income statements, you might want to look and say, okay, did they include income taxes here for the state income taxes that might be personal taxes that shouldn't be deductible possibly because they're being based on the net income, and then think about whether or not that line item is right. And then you might be thinking about whether or not, say, the property taxes on, say, a home is included in that line item, where you would then have to break it out between the portion that was personal and for business use, and you might have to do kind of adjusting entries in order to do that, to break that information out. So ordinary and necessary then is going to be the general rule. The federal income tax is kind of an exception to that rule because, again, we're kind of calculating the federal income tax. Now then we have the sales tax. Sales tax can be a little bit confusing. So if we are paying sales tax, meaning we buy something and have to pay state and local sales tax, we typically will deduct it, but not as a separate line item of sales tax, but rather include it in the category of whatever we're purchasing. So if we purchase supplies and we're deducting supplies and we paid sales tax for the supplies, then we'll include that in the expense of the supplies that we are purchasing. If we purchase equipment that we're going to have to depreciate, we will typically include the sales tax that we had to pay in the equipment that we purchased in the purchase price and then allocate the cost of it over the useful life of the equipment. Now, if you are paying sales tax, you have to collect sales tax and then pay to the government for goods and services that you are selling. Then you got to be aware of your accounting method that you're going to be. Note that the general rule would be that you would not include the sales tax portion of the sales and income, and then the sales tax expense side of it, when you pay the sales tax, would not then be an expense. But sometimes you might have it included in the income. Like, for example, you might get a 1099 in the situation where you're receiving a 1099 and the person is including both the sales tax portion as well as the non-sales tax portion on the 1099. That 1099 went to the IRS. The IRS then is expecting to see the sales line item reflecting total sales, including possibly the sales tax. That might be a situation where you would need to report the sales, basically including the sales tax. If that were the case, then you should have the expense side of things related to the sales tax as well. But again, if you're using accounting software for the most part, then it will not be including the sales tax typically in the sales line item, in the income line item, and therefore also not including the expense on the expense line item you're using. So just note that if you're including, of course, the sales tax when you make the sale in revenue, then you would think, of course, that you would get the expense related to sales tax as well. And those two things would basically net out, because the sales tax is not really part of your sales, really, or part of your sales price. They're charged, the government charging the client. So in that case, if you're increasing the sales, then you should get the deduction for sales tax. However, many accounting softwares note that when you record the invoice and you're charging sales tax, it will not be increasing sales for the portion of the sales price that is for sales tax. It will be increasing a liability for sales tax. And then when you make the payment, it'll be coming out of the liability, sales tax payable liability account. So just remember, if you deduct sales tax, then you have to have included the revenue related to the collection of the sales tax in the revenue line item. So you got to match those two things out. And remember that a lot of accounting software will not be including in the revenue line item the sales tax, because again, it put it into the liability category. The net effect on net income should be in essence the same under the two methods, but if you're going to include it in revenue and an expense, then your gross receipts will be bigger and your expenses will be bigger. If you were to remove it from the gross receipts and the expenses and simply record it through the liability account instead of reporting it on the income statement, then your net income should be basically the same, but you'll have a lesser amount in the revenue side and the expenses side. So just be careful with the sales tax. It can be a little bit tricky, and you want to see how your accounting method is being set up. Then we have the employment taxes. You can deduct the Social Security, Medicare, and federal unemployment taxes, or FUTA, F-U-T-A, you paid out of your own funds as the employer. You can also deduct payments you made as the employer to a state unemployment compensation fund or a state disability benefit fund. So we talked about these when we talked about the wages more, and the deductibility of wages and payroll taxes. Just remember that the amount that was pulled out of the employee wages is not something that can typically be, well, it is going to be deductible, but that'll be deductible as basically just employee wages. And then the amount that the employer had to pay over and above, that's the amount that could be broken out into the payroll taxes. And remember that a lot of accounting software like QuickBooks might not be breaking them out by the default settings. It might just put them into wages. Again, the net effect on the net income would basically be the same, but you generally should, break out the tax portion, the payroll taxes, into another line item, and it would be best to be verifying the deductions in both that and the payroll to what was reported in the payroll tax returns on the W-3, the 1090, the 941s, and the 940s. Then we have the self-employment tax. You can deduct 1/2 of your self-employment tax on lines on Schedule 1. Self-employment tax is discussed in Chapter 1 through 10, so we talked about that in a prior presentation. Self-employment tax on the Schedule C then would be, we got the net income on the bottom of the Schedule C. We're still talking about Social Security and Medicare primarily, as we were with the payroll taxes, but rather than being based on other people's wages, we're talking about the self-employment, what's left in the net income of the Schedule C, which then you're going to be applying the self-employment tax to, and 1/2 of that you get to deduct, not on the Schedule C, because it would create kind of a circle reference. We're using the Schedule C to calculate the tax, and then we got to take the deduction. It goes somewhere else, that being on Schedule 1, Part 2, basically an above-the-line deduction. Then we have personal property tax. You can deduct on Schedule C, CEZ, any tax imposed by a state or local government on personal property you used for the business. So if we had personal property, equipment, or whatever that were used for the business and they imposed taxes on it, that would typically be something that we can deduct as taxes. Real estate taxes, you can deduct on Schedule C or CEZ. Real estate taxes you pay on your business property. Deductible real estate taxes are any state, local, or foreign taxes on real estate levied for the general public welfare. The taxing authority must assess these taxes uniformly at a like rate on real property under its jurisdiction, and the proceeds must be for general community or government purposes. So if they assess real estate property, obviously if the real estate is used for the business exclusively, typically you can deduct that as basically taxes. And if you have real estate taxes on your home, which you're going to use in part for business, that's when we might have to be allocating using basically the business use of the home form part of those taxes to the Schedule C, and part of those taxes then may be still deductible on, say, the Schedule A if they are able to itemize.